Good afternoon. Today on the final bar, we're going to wrap the week, take our normal Friday routine of looking at some of the big picture trends, how they've evolved. Today was sort of a choppy to down day, but we ended up finishing fairly strong. And so in the end, we've sort of continued this sideways trend. The market can move three directions, up, down, and sideways. This has been sort of the sideways mode. So what we're going to do is look at some of the longer term trends, how they've evolved for me. Also, my market trend model, which just turned positive on the medium term. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the day's price action. And on a Friday, thanks especially for joining us as we wrap this week. Lock in Friday's close is sort of look at where we've come from and start to think about where we're headed going into next week, start to hopefully set the stage for a good weekly review of the charts and the longer term trends. You know, as I mentioned, today ended up being really about choppiness. Although we finished more in the positive, it still was more of a choppy day than anything else. And an appropriate way to end up this week, heading into the long holiday weekend. I think there are a lot of question marks in terms of what's heading next, and hopefully together we'll be able to answer some of those questions. Just wanted to point out, coming up on on StockCharts TV and on the Final Bar, we've got some great guests coming up for you. On Monday, we're taking the day off for Memorial Day for this show, but we're going to show a really cool episode just while we're taking a break, and it's piecing together some really good content we've done related to flying and investing. As a student pilot, I learned a lot about how to aviate, how to navigate, communicate as a pilot, and there are so many lessons from learning to fly that learning to investing, there's just so many parallels. And so we're going to have a really good episode on Monday, sort of highlighting some of those ideas for you. Also on Behind the Charts, Joe Duarte from Joe Duarte and the moneyoptions.com, one of our newest Stock Charts contributors, is going to be there for an interview on Monday. Later in the week on Wednesday, we have Katie Stockton from Fairlead Strategies. On Thursday, Ryan Dietrich from LPL Financials. And again, we're so fortunate to have some really capable guests. This week was fantastic with some of the guests that we had on, and next week, Katie, Ryan are two of the best technical minds that I'm friends with. So we're excited to have them be on next week. Let's talk about a market recap, and then we'll wrap the week in a little while. When we look at today's trading, as I mentioned earlier, when coming out of the open, we sort of sold off in the first 30 minutes, and from there spent the morning session sort of in the lower end of the range, and which is unusual because more often than not, leading into a long holiday weekend, the two things you can usually bank on are lighter volume and a positive move. It's rare that you close down on a day before a long holiday weekend. So I was kind of surprised at the open it was a little lower, and we had some moments that felt certainly more distributive by the close. We're back up to 29.55 on the S&P, which is up about 0.25%. So not a huge change in character, but certainly a break from the last couple of days, which have been a little more choppy distributive. The mid-cap index actually flat on the day, so just a hair above the zero line. Small caps up 0.5%. So small caps leading the way. And if you look at the chart of the small cap index, you can see they came on strong from just before launch on through the close. So certainly a move into more higher beta opportunistic names by the end of the day. It's interesting though, if you look at the sector picture, it's not like it was the big offensive sectors that rallied. It was REITs and utilities, the two top sectors. So this was not a feel good, everything's okay kind of day. It was more of a digestion day. And that's usually my shorthand way of just talking about a day that was not necessarily a directional trend. It was not telling you there's huge positive sentiment. This was more just a way of digesting what's been coming up and sort of preparing, getting things cleaned up for the weekend. Some of the sectors have been following so much. Technology as a leadership group, sort of flat today relative to the market, sort of similar to the market returns. Same with healthcare, two sectors we've been looking at pretty closely. On the bottom, you can see energy led the way down, followed by financials, materials, energy. But again, no huge dramatic moves across the board. It was a pretty sideways day, to be honest with you, more than anything. Let's look at some other markets, and we're going to talk about a chart of the S&P 500. Bonds actually finished stronger. They came on strong in the morning, so sort of stocks down, bonds up. But bonds actually remained fairly strong with the TLT closing above 165.50. On the commodity side, you had gold actually remaining fairly strong for the entirety of the day. Again, only up 0.6%, so not a huge move, but certainly one of the gainers when you look relative to other assets. Oil actually down today with the USO down almost 4%. That's in line with energy being one of the weaker places. When you look at chart of the S&P 500, and we'll talk about this a little more when we get to wrap the week, but this week was really this section right here. We had the gap up into Tuesday's session, and then beyond that, we really just kept, in my opinion, validating the importance of this resistance area. I've had this shadowed orange area on the charts for a little while here as we got closer and closer to that 61.8% retracement level, and saw that the 200-day was lining up very well with this. So there's this confluence of resistance, and it lines up actually coincidentally just below the lows from last summer, also the low from the beginning springtime of last year. So a lot of reasons why this area should be a pretty good resistance level. And that's kind of where we've netted out. No real follow through. Even the times when we broke above that 29.50 level, we really haven't pursued it any further. We've sort of digested, kind of come back down. So, I think going into the long weekend, I think you have to feel pretty good if you're long and have ridden this higher. It probably feels pretty decent. If you're short or more negative, you probably don't feel that bad either, only because the risk reward is fairly positive. So from a trend following perspective, this medium term, short term trend has been pretty constructive here for sure. And I think next week is when we'll hopefully get some signal about what the next direction would be. Again, as I always remind you, the RSI still has not eclipsed the 60 level, which just tends to be more in a bear market environment than a bull market environment. Let's look at some of the other themes that have emerged today, and then we'll get to our weekly wrap session. So a handful of global ETFs outperformed the S&P today. Germany was about flat, but Mexico and Italy above. So there were a couple markets that were higher, plenty lower. So we had that continuation of the weakness. And again, there's a lot of news flow out of China in terms of how the markets are potentially going to be affected, new plans for how to manage things. And so that's certainly weighing heavily on things like the FXI. That's one of the more common, more frequent ways we've looked at it. And we think about the S&P that's rallied to about 61.8%, sort of testing, potentially breaking out, arguably breaking out, and testing its 200-day from below. A different chart here on the FXI, but still, it's below the 200-day and has not been able to eclipse that level. What's interesting here, though, is in the last couple of days, you've seen the heaviness of the market. It's now testing the lower end of this range. So just like the S&P sort of at the upper end of the range, you have China at the lower end of the range. That's why this relative strength has rolled over so significantly, because of, again, this holding back while the S&P is more, finishing in a position of strength. So it'll be interesting to see into next week if you get some sort of, up move in those, you get some sort of improvement on a market that's been relatively underperforming. In terms of industry groups that were on the move, you had materials at the number one spot in the form of aluminum shares up over 5%. Specialty REITs were up over 3%, and that's why the real estate sector overall did okay. But interesting to see travel and tourism in the top 10, home construction. So home builders in general have held up very nicely, and that's representing that. But a mishmash of other sectors as well. You have some transportation-related groups, medical supplies, which is in healthcare. We've talked about that at different times, and my guest this week, Doug Bush, focused on healthcare. So those stocks are sort of top of mind for me as I'm going into the weekend and thinking of a review of the S&P 500 charts. On the bottom, worth noting, airlines back to the lower end, and we've talked about a group like airlines. On this show, we focus a lot on the daily changes because that's what updates the longer term chart. But again, I would always be a little wary of a group like airlines, as much as that can be tempting. And again, it could certainly do incredibly well from here. But as a trend follower, if you zoom back, I see a pattern of lower highs and lower lows. That's not what uptrends are made of. That's more by definition a downtrend. So certainly pay attention to the trends, especially on some of these groups that have been beaten down, until they earn the right to draw consideration for you on the long side. That's our market recap for today. And again, to be honest with you, it tends to be a lighter volume going into the holiday weekend. I think that's what we sort of saw here. I don't think this was necessarily a directional bet suggesting strong strength or weakness. I think it's still validating some of the things we've talked about up until today. And that's why I want to go into our next segment, wrap the week. So Fridays are a great one, in my opinion, because what we do is focus on the weekly close. We've locked it in. What does that mean? How has the long-term picture changed? What sort of tips can we pull out of that? And what I like to do is start with the Mindful Investor Live ChartList. This is the way that part of my weekly review process. If you've not used this before, it's easy to find. Click on articles, go to the Mindful Investor, which is sort of my homepage on StockCharts.com. And at the very top, you'll see a link for a live chart list, and that'll get you to this point. You're welcome to save the charts, send them to your friends, do whatever you like. So chart number one is the market trend, and it's worth noting here for the first time since last February, the medium-term trend that I follow, this is using the weekly PPO, just turned bullish on today's close. It triggered, it threatened to trigger earlier this week, but you really need to wait until the weekly close to lock in that buy signal. And just this week, it's finally turned positive. So you may ask, well, hold on a second, how has it been negative this whole time? Coming from the March lows to where we're at now, and I totally hear you. So the way that my market trend model has evolved is you've got three time periods. You have the long term, which for me is sort of a couple of years-ish. You've got the medium term, which is a couple months to a year probably, and then you've got the short term, which is a couple days to a couple weeks. And the idea is you look at the alignment of those three different timeframes, and based on what you're trying to do, that should, for me, it's not a system. It's not something I use, as a rules-based platform, but it is a something that runs in the background. I like using it as a way, as a lens with which to understand what I'm seeing around me. Just make sure that I understand where the trends have been headed from. So the severity of the sell-off certainly, shocked the model because, the downtrend happened so quickly, and usually it's a little more of a gradual turn, but did turn negative there in February. This is on that medium-term time frame. And then again, the uptrend, it was such a beatdown, and it took a long enough. There's enough of a time factor built on this weekly data to finally trigger it. So the short-term signal turned positive there at the end of March, which is sort of after that big first move out of the March lows. Now the medium term has turned positive. The only one remaining negative is the long-term trend, which is based on the 21 and 34 week exponential moving averages. And so it really wouldn't trigger until you get, again, it's sort of a continued follow through. I could see if the S&P gets above 3,000, the spiders get above 300, S&P gets above its 200-day and is able to hold that, I think you would see the long-term signals start to trigger fairly quickly, given the trend up until then. But worth noting, at this point, the short-term tactical trend, the medium-term trend, now positive. And again, that's not much of a surprise. And I still think we could go either way from here. And I think this will end up making a little bit of sense. It makes sense that this has been a significant run out of the lows. And now the question is, are we able to push through, invalidate the bear market rally thesis and return to previous highs? And so I think it's right about at that point where it makes sense that that medium-term trend would swing positive for the model. As we mentioned with the daily chart, I think we covered this enough, but again, I think we're at that confluence of resistance. I think it's really key to see where we're at here. And it's not just on the S&P chart. If you look at, Cisco, you see it facing resistance, Apple, some of these bigger names, Microsoft, approaching what could end up being a huge double top pattern, or it could be the breakout. Those stocks break materially above their early 2020 highs. I think you could be fairly optimistic about where we go from here. But again, my base case has been, we're at the later stages of a bear market rally. We correct a little bit. I think a break below 2,800, 2,750 is what really confirms that as the next leg. But for this point, we're sort of up in resistance and holding. Looking at breadth, I've color coded these sort of neutral because you had a rally out of the lows on the cumulative advanced decline lines. This is looking at the daily breadth reading and accumulating those values over time. And so on the S&P, on mid caps, and then at the bottom on small caps, it's showing you where we're at relative to those. I noted a couple weeks ago, they all sort of broke down through a trend line, which to me was a potential signal that this was the next leg down. That's sort of, reversed, right? So you sort of now continue this pattern of lower highs and lower lows, but the market's not going down a ton. So I think reversing this pattern, higher highs, higher lows, would turn this more positive. When we get sort of a breakdown through the most recent lows, start to continue this pattern, the short-term downtrend pattern, I think I color code those red, and it suggests weakening breadth. But at this, it's sort of sort of at a standstill of a little positive, a little negative. The new highs and new lows hasn't been much of a signal. I think that's characteristic of what happened up until today. If you look at the S&P, it's about 2/3 of the way back up, retracing this move, and that's where the average stock theoretically is. You had a lot of stocks making new highs in February, a lot of stocks making new highs in March, or new lows in March, excuse me. You had a handful of new lows on these pullbacks. A lot of that was like energy and others, but since then it's been sort of a non-factor. And you had this signal last week where you started to have an increasing number of new lows. And this is as the market was going to the lower end of the range. But since then, this week kind of we popped up and we've sort of remained more at the upper end of things. So at this point, it's sort of a neutral, no real signal on either side of there. The breadth in the form of the 50 and 200-day moving averages has been really key. I think it's interesting to just take a step back and note that at the end of March, literally 0% of the S&P, none of the 500 stocks were above their 200-day or above their 50-day moving average, excuse me. Less than 5% were above their 200-day. From that moment of 0% above their 50-day moving average, we now have 4 of 5 above their 82% of the S&P has now recovered that level. So again, while not a signal of a long-term uptrend, certainly speaks to the reaction move out of the March low and how significant so many have come up. Also interesting to note that still 2/3 of the S&P below their 200-day moving average. So just like the S&P has not yet eclipsed it, most stocks haven't either. So until you see that, until that breaks above 50%, until you see a meaningful number of stocks getting above their 200-day, that long-term trend, I think it makes sense that it's still more on the negative side. The AAII rankings, just to finish on a couple more charts here for our weekly wrap session. Interesting to note, a lot more bulls this week. So as the S&P sort of closed above its most recent swing high, and certainly a higher high for the uptrend out of the March lows, you saw more bulls. Still not as many as we had after that initial push out of the lows, so still a little weaker, but certainly a transition from more bears to more bulls. And so the spread between them is still 16%, so still plenty more on the bearish side than the bullish side. Then we have a series of ratio charts, and as you have time over the weekend or whenever you make time for a weekly review, I hope you can look through some of the charts like these, looking at things like within consumer. I've found that the cap-weighted version certainly indicates that consumer discretionary, the offensive side of consumer, has done better than the defensive side. The equal-weighted version has not nearly as high, but also starting to break out. So just at the end of the week here, breaking above the swing highs from April. So both on a cap-weighted, which is dominated by Home Depot and Amazon's the biggest weight in consumer discretionary. On the downside, it's equal-weighted, but still breaking out to new swing highs. So sort of confirming within consumer, there's been this continued rotation away from the defensive side of the ledger to the offensive side. A lot more charts in the live chart list here, and I hope you have time to go through it. If you have questions, just shoot them to us via email. We're happy to address them in a future show. We're going to take a quick commercial break. Back with the final bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love answering your questions and appreciate the benefits of this show, being able to help you navigate these markets, help you manage your portfolios and empower you to make better decisions. Shoot us an email with any questions you have on the markets, on the charts, on the StockCharts platform. We're happy to answer them for you. The final bar at StockCharts.com, best way to get a hold of us. Want to get to the final bar mailbag a couple times a week. We take your questions. These are all questions we've received in the last day or two, and we've been getting a great number of questions. And the good news is we'll get to a lot of these. The ones we don't get to, we'll get to next week for sure. We'll have another mailbag on Wednesday, I believe. First question, I like the RSI. It's a staple of my technical approach. That's great, and many others. But one danger of the RSI, you could think you're looking at a divergent top when really you're in the midst of a strong uptrend. Two very opposite signals. Are there confirming indicators you may use? And you asked about a particular ticker. I'll bring one up here. Let's talk about DXC. All right, DXC Technology Company. Yeah, great question. So the question is, what is a divergence and what is not a divergence? Sorry, I'm looking at like a 1-minute chart here. That's miserable. Give me a second here. We'll go to a daily chart here. So, how do you use the RSI for divergences? So I'll tell you this, it is definitely more of an art than a science. And one of the not the challenges, but you have to remember that when an indicator becomes overbought on its own, that's not necessarily a bad thing. So here in November of last year, when the RSI became overbought, that doesn't necessarily tell you that the uptrend is over. That just tells you that stock's been going up a lot. And that's kind of good, right? Same when the RSI became oversold here in late February. It doesn't tell you that that's the bottom. It just tells you it's been going down a lot. So, the things you look for are, number one, when it's been overbought, it starts to come out of the overbought region. That's the signal that overbought condition has been alleviated. On the downside, you wait for when it's coming out of the oversold region. So this is a signal that it's going down a lot. Here in late March is more of the signal that the downtrend is sort of reversing and momentum is sort of coming out of that downtrend. The second question is more about divergences, and I'm not sure exactly which one you're looking at, so I'll just look at this one here in November and December, right? So when the stock rallied into the November highs, you see higher highs, and it's compressed a little bit because of the sell-off here in March, but higher highs into December, but lower peaks in the RSI. So I think that is a pretty good divergence of higher highs in price, lower peaks in the RSI. But your question is, what happens if it goes higher? And I think you always have to be wary of that. And you've found stocks, and I mean, there are plenty. Starbucks, when it was on its multi-year uptrend, the FANG trade, when it just kept going higher and higher, you had some divergences along the way that didn't really play out. And so what I think you always want to look for is what invalidates or what validates a signal. For me, a divergence is what puts it on the radar. The breakdown is in price is what confirms it, right? So, we have a bearish divergence, higher highs, lower peaks in the RSI. That's a good starting point. Where is the actual signal? For me, it's more when it starts breaking down through maybe the swing low in the middle of that divergence, breaks down through the 50-day moving average, the RSI breaks to a new swing low, like all of those sort of confirm that, a top might be coming. Now we're getting a confirmation that the trend has now turned over. So having some signals, some indicators that would validate what you're seeing with the divergence, I think makes a ton of sense. So yeah, there are plenty of ways to do that. Hopefully, as we go along with the show in the future, we'll continue to hit on some of those. Next question was on NVDA. Talked about this randomly. Let's see. It looks like the stock could be forming a really nice bottom, a W or a round bottom, okay, and break out to this new high. Should be very bullish. Oh, why did the stock sell off today? This was asked. Yeah, I think you asked this yesterday, by the way. Yeah, can a stock fail even though the technicals are strong? This is such a really interesting question. It's a very genuine, authentic question. I really appreciate it. What happened? You're to summarize your question. This chart looks pretty good. How could it be going down at times? And listen, I would love to tell you that anything that we talk about using charts is 100% or even anywhere near that. It rarely is. And so I found, for me, technical analysis is not about getting the signals right. It's not about reading the charts right in terms of your entry points. Having a good money management strategy for how you deal with the signals that don't work is arguably more important. And I'm thinking of, people that write trading services and send a lot of ideas out there, especially on the institutional side that I followed for years. You were not right 100% of the time or anywhere near that. You were wrong a lot. And getting used to that is actually very difficult as a professional money manager, as an investor at any level. So being wrong, accepting that you're going to be wrong and understanding how you're going to deal with that is really important mentally. But in terms of practically how you do it, you have to have some sort of exit strategy. So I always think of it, and I don't always take the time to articulate it on the show just because of time. But if I had a stock like NVIDIA, what I would say is something like, I own NVIDIA, I'm long it at this level because of XYZ. If it breaks 305, which would be the most recent swing low as an example, then I'm going to cut 50% of my position. And if it breaks the 50-day, I'm going to cut the other 50%. Not saying that's exactly what I'm recommending or anything here, but I'm telling you that's the way that I would phrase an entry point. Your entry point decision includes your exit strategy. You always have to have the exit strategy in mind. And if you do that, you will continue to not be right all the time. But when you're wrong, your losses will be limited and you'll be able to continue on. So you're right. There are so many things that drive equity prices. The charts, more often than not, are going to help you, and they'll always help you. But the more often than not be right, what you want to do is make sure you have an exit strategy for when they're wrong. Next question, what's the difference between the scooter rankings and relative strength? Do we need both? That's a really good question. And if you look at the charts that I show, I always show relative strength because, as an institutional investor, that's what you're trained to use because that's how you get paid. That's how you get evaluated, is your ability to outperform a benchmark. So when I'm working with a fund manager, that's the line we would focus a lot of our time on. The scooter rankings that we have, I use them as a current view. I use them as a way to rate stocks, to rank them, to look at where sectors are relative to one another. They're all really good for that. You can also use them as a data series. And guys like Greg Schnell, Tom Bowley, who do content for StockCharts, do a really good job of showing you how they incorporate that into their analysis. I don't as much because I feel like I have a good read on the relative strength with the relative line, right? Looking at the ratio. You could use either, to be honest with you, and some of the analysts and investors that I know and trust and support a great deal use the scooter rankings as a data series. So I don't know if you necessarily need both, but I would certainly be looking at one of them for sure. And I think in the end, it's all about what lines up with your time frame. Final question, we just have 1 minute left here, was Kim Sokoloff was my guest yesterday, and the stochastic indicator she spoke about used the S&P and Goldman Sachs, if I remember right. Oh, is it possible to send the parameters? Yeah, so I'd set this up earlier, just looking at trying to just recreate some of the charts that we had looked at together on there. And what I came up with was this. There's an indicator called full stochastic. Stochastics are a little busy only because there's a bunch of different settings that you can use. So it a lot of times can be hard to line things up because the counts can be very different. What she was using was basically a full stochastic. So the first day is saying over X number of days, where are we at versus the highest high and lowest low for that time frame. And then it's a 3-day moving average of that. And then it's a 3-day moving average of that one. And those are the two lines that you're showing up here at the top. Long story short, indicator full stochastics parameters 5, 3, and 3. It'll look like this. And that's going to look pretty close to what Kim was showing us on the air yesterday. It's all the time we have for the mailbag. I want to thank you guys all so much for those questions. We had some others that came in before the show, and we'll go through those and get them on our next segment beginning of next week. All right. Now it's time to wrap the show with a 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is consumer discretionary sector. On Monday, well, actually, sorry for the holiday, on Tuesday, we will do our trifecta of market analysis, top-down sector rotation, and bottom-up stock picking. In our sector segment, we always look at the 11 S&P sectors using a couple different tools, and consumer discretionary really emerged this week and really the end of last week, really, because the S&P is sort of in this range where it's, in a range-bound trend. It's testing its 200-day moving average from below. Consumer discretionary kind of already did that and resolved more positively. So if you're thinking of a bullish argument, the breakout in consumer discretionary on a relative basis as well, I think is super valid. You had this real clear range between about 118 on the top, 110 on the bottom. We gapped above the 200-day and resolved that higher, and certainly suggest higher highs from here and a return to previous highs. It's in pretty good shape. Growth versus value continues to lean to growth. And again, I always read things talking about the return of value and just trying to find when that is. Again, as a trend follower, the beauty is you don't have to guess. You just have to wait for the trend to tell you that that's in play. And it is not in play yet, according to any of the ratios I looked at. Regardless of how you look at it, I'm doing the IWF over the IWD, still leaning toward growth overall on the long-term time frame. And I think that's set to continue. Finally, just one last chart. I was looking at some of the sentiment charts that I have in one of my chart lists and cleaning them up a little bit. I came across this one that I haven't referred to in a while. This is looking at the name exposure index, which is basically showing you active investment managers and how much they're allocating to equities relative to other assets. On the bottom is the Ridex flow. So it's looking at bearish bets versus bullish bets, right? So the stronger the number, and I've inverted the scale, so the lower these red bars, the more bearish investors are positioned. The higher the bars, the more bullish they're positioned. And what struck me is two things. Number one, if you look at the Ridex indicators, at the bottom here in March, we were similar to the bottom in December of 2018, which I don't think I'd really paid attention to at that point. We've now come back up. We're getting close to those levels we were after those big rallies and before a bit of a pullback. So lining up with sort of that rally into resistance sort of thesis. Folks, that's our show. That's a week for the final bar. As a reminder, we're taking Monday off, but we're going to have a fantastic special relating flying to investing. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.